Today we're going to be discussing a tax planning strategy to get tax-free income from the short-term rental of your personal residence. This is commonly referred to as the Augusta Rule. The IRS has a provision that provides that you can exclude rental income from your personal residence if you rent your personal residence for less than 15 days per year. For years, homeowners have taken advantage of this rule to pocket some tax-free income when special events roll into town. It's called the Augusta Rule because if you live in Augusta, Georgia, and you're not a golf fan, you can rent your home to people coming to town to watch the Masters Golf Tournament every April. The same principle works for similar events. If the Super Bowl or the Olympics or a national political convention come to town and you can find somewhere else to stay for a while, you can take advantage as well. The problem with all these choices is that they involve renting your home to strangers who may or may not respect your home the way you do. Fortunately, there's no requirement that you rent your home to strangers. That means you can rent your home to your business, deduct the rental payment from the business like any other rent you'd pay, and pocket the income tax-free on your personal return. In other words, take the money out of one pocket where it's deductible and put it in another pocket where it's non-taxable. Pretty neat, right? However, you cannot rent your home for more than 14 days for this provision to apply. As with most deductions, you have to dot your I's and cross your T's to make it work. The first requirement involves qualifying rental occasions. Code Section 274A1B, also known as the Entertainment Facility Rule, disallows deductions for facilities used for entertainment, recreation, or amusement. This means you can't rent your home to your business for parties. However, there are still plenty of occasions you can host at home. Annual shareholder and directors meetings, off-site employee retreats, client events where any meal or entertainment you serve up are incidental to the client event, as opposed to being the point of the event. You also have to pay fair market value for the rent. You can't just say your house is worth $5,000 a day and call it good. Remember, any business expense you deduct under Code Section 162 has to be ordinary and necessary. But how do you determine that amount? You can go online, search through Airbnb listings, and see what comparable landlords are asking for their homes. You can call local meeting spaces to determine what they charge for similar spaces. Another rule of thumb is to take 20% of the home's monthly rental value as listed on Zillow. Needless to say, there's no case law here, so be sure to show that you've done some homework and you feel comfortable signing a tax return that deducts that amount. If your business pays you more than $600 in rent, you should report the payment on Box 1 of Form 1099, Miscellaneous. Of course, now the IRS will know that you're getting that income. How do you report it without paying tax? You'll include it on Schedule E, page 1, where you'd report any other real estate rental. Drop the gross rent into line 1. Then in the other deduction section, include the same amount and note it as non-taxable under Code Section 280AG. Your net result is no taxable income. If you have any more questions about our services or the Augusta Rule, please call us at 972-200-7335.